Hello, I'm John A.G., and before we talk about prices, charts, or predictions, I want you to focus on something far more uncomfortable. Markets do not collapse when numbers look bad. They collapse when assumptions stop working. For decades, the silver market functioned on a quiet agreement that most participants never questioned. Paper claims would circulate freely, physical delivery would remain rare, and price could be managed through leverage, liquidity, and confidence. That agreement is now breaking. Not loudly, not dramatically, but mechanically. What I am about to walk you through is not a theory, and it is not driven by emotion. It is a sequence of observable facts that no longer reconcile. When systems reach that point, change is no longer optional. It becomes unavoidable. February 2026 is exposing that moment for silver. The problem did not start with a price move. It started with behavior. In the opening days of February, nearly 19 million ounces of silver were removed from the COMEX for physical delivery. On its own, that figure would raise eyebrows. In context, it becomes alarming. That volume nearly matches the entire amount delivered during all of February last year, compressed into a matter of days. This is not random variation. This is acceleration. But the real signal is not the quantity. It is the decision behind it. Approximately 98% of open interest chose to stand for delivery. Not roll forward, not accept cash, not defer responsibility. They demanded metal. When almost everyone chooses the same exit at the same time, it reveals a loss of confidence that no intervention can easily repair. For years, futures markets relied on the assumption that delivery was theoretical. Contracts were exposure tools, hedges, or speculative vehicles. The metal itself remained mostly stationary, while claims multiplied above it. That structure only works as long as trust remains intact. Once participants decide that paper exposure is insufficient, the system is forced to confront its own limits. What we are witnessing now is the early stage of that confrontation. Physical silver is being prioritized over promises, and that single shift changes everything. March 2026 is where this becomes impossible to ignore. Open interest for the March contract currently sits near 80,500 contracts. Each contract represents 5,000 ounces. That translates to more than 400 million ounces of silver theoretically obligated. Against that, the COMEX registered category, meaning silver actually approved and available for delivery, holds just over 100 million ounces. The system is leveraged roughly 4-to-1 against its own vaults. This is not speculation. It is arithmetic. When leverage reaches this scale in a delivery-based market, outcomes narrow dramatically. The critical question is not whether all 400 million ounces will be demanded. It is what happens if even a fraction is. Industrial users cannot substitute paper for metal. Manufacturing requires physical input. Funds responsible for backing assets cannot ignore counterparty risk indefinitely. Sovereign entities diversifying reserves away from financial instruments require custody, not exposure. When these participants align in behavior, the exchange ceases to function as a clearing mechanism and becomes a bottleneck. February's delivery data strongly suggest that this alignment is forming faster than expected. This pressure is not confined to one exchange, it is global. In China, visible silver inventories across major vaulting systems have fallen below 30 million ounces. That figure is astonishing when viewed against China's industrial expansion. Solar manufacturing continues to scale. Electric vehicle production accelerates. Artificial intelligence infrastructure is being deployed at a pace that demands immense electrical and thermal efficiency. All of these processes consume silver because no substitute matches its properties. The eastward flow of metal that has characterized precious metals markets for decades has intensified into a sustained drain. Silver is leaving Western vaults and moving into long-term industrial and strategic use. London reflects the same stress. Estimates from the London Bullion Market Association place the global free float of silver, meaning metal not already allocated or spoken for, at roughly 150 million ounces. That number sounds large until you consider global industrial consumption, which now runs near 75 million ounces per month. At that pace, the entire free float represents about 2 months of demand. That is not a buffer, it is a fuse. Once it burns down, price must adjust to ration demand or attract supply, because no hidden inventory exists to fill the gap. One of the most revealing signals in this environment is the behavior of silver lease rates. Lease rates measure the cost of borrowing physical metal at the wholesale level. In a market with ample supply, these rates remain low. There is no reason to pay a premium for abundance. When supply tightens, lease rates rise. Recently, silver lease rates surged above 6%, the highest levels seen in years. This is not retail speculation. This is banks and bullion houses paying more to access metal they are presumed to already hold. Elevated lease rates signal scarcity. Scarcity introduces stress. Stress forces repricing. Recent price volatility has distracted many observers, but it fits this framework precisely. Silver surged to approximately $120 per ounce in late January before collapsing sharply, falling nearly 50% in days. That move was not driven by fundamentals breaking, it was driven by leverage breaking. Excessive speculative positioning, built on borrowed capital, pushed prices beyond what the short-term physical market could support. When margins were raised repeatedly in rapid succession, leveraged positions became untenable. Forced liquidation followed. Algorithms amplified selling. The result was violent, but it was not random. What mattered was what happened afterward. The speculative froth was removed. Weak hands were shaken out. The market stabilized near $82 per ounce, a level supported by physical demand rather than leverage. Importantly, physical indicators did not improve during the sell-off. Inventories did not refill. Lease rates did not collapse. Delivery behavior did not reverse. The price reset cleared instability without resolving scarcity. From a structural perspective, that strengthened the foundation for what comes next. The broader supply and demand picture reinforces this conclusion. The year 2026 marks the sixth consecutive year in which global silver demand exceeds supply. Mine production remains near 800 million ounces annually, while total demand approaches 1.3 billion ounces. That leaves a deficit of roughly 500 million ounces each year. Recycling contributes, but it does not close the gap. The difference is filled by drawing down above-ground inventories, accumulated over decades. Those inventories are finite, and they are shrinking. New supply cannot respond quickly. Developing a silver mine requires years of permitting, capital investment, construction, and commissioning. Even dramatic price increases do not translate into immediate production. In the meantime, demand continues to compound. Solar energy remains the dominant growth driver. Photovoltaic cells require silver for electrical contacts because its conductivity is unmatched. Electric vehicles embed silver deeper into transportation infrastructure. Artificial intelligence adds an emerging layer of demand through data centers that require extreme efficiency and thermal management. These uses are not discretionary, they are structural. This is why silver occupies a unique position. It is both a monetary metal and an industrial necessity. It exposes stress in financial systems while simultaneously revealing constraints in physical production. When those two forces intensify together, price becomes the mechanism through which reality asserts itself, not gradually and not politely. February's delivery data, rising lease rates, global inventory drawdowns, and persistent deficits are expressions of the same underlying truth. The paper representation of silver is losing credibility. Physical metal is reclaiming authority. The gap between those two worlds is narrowing, and once it closes, the adjustment will not be subtle. What happens next is not determined by opinion, but by constraint. Markets can stretch logic for long periods, but they cannot escape arithmetic. The nearer we move toward first notice day for the March contract, February 27th, the less room remains for interpretation. First notice day is when futures markets stop being theoretical and start being physical. It is the moment when contract holders must choose whether they will roll positions forward, settle in cash, or demand delivery. February has already shown us which option is gaining favor. When nearly everyone chooses metal over paper, it signals a structural fracture, not a temporary anomaly. If only a modest percentage of March open interest stands for delivery, the system faces immediate strain. 400 million ounces of claims against just over 100 million ounces of registered silver leaves no margin for error. The exchange is not designed for unanimity of intent. It is designed for deferral. When deferral fails, the exchange must improvise. That improvisation rarely preserves confidence. Cash settlement becomes the first tool. Paying premiums to avoid delivery quietly admits that the posted price no longer reflects physical reality. Delivery delays become another tool, forcing buyers to wait for metal that may not exist in accessible form. The final lever is price repricing, where paper prices rise sharply in an attempt to attract metal from elsewhere. None of these options restore normalcy. They merely manage exposure. This is why delivery behavior matters more than commentary. Futures markets rely on a delicate balance of expectations. As long as most participants assume others will not demand metal, the system functions. Once that assumption breaks, coordination emerges organically. Participants act independently, but outcomes converge. February's 98% delivery rate is not coincidence. It is coordination without communication, driven by shared perception of risk. The global context amplifies this dynamic. Silver inventories are not declining in isolation. They are falling across every major vaulting hub. Western exchanges show consistent drawdowns. Eastern markets maintain elevated premiums that reflect urgency rather than speculation. The arbitrage mechanism that once balanced these flows struggles under the weight of logistics, timing, and availability constraints. When metal cannot move fast enough to equalize price, price must move instead. That adjustment tends to be abrupt. The macroeconomic backdrop offers little relief. Global debt burdens continue to expand. Fiscal discipline remains absent. Monetary systems rely increasingly on confidence rather than restraint. Central banks themselves signal this reality through persistent accumulation of tangible reserves. While silver differs from gold in role, it responds to the same erosion of trust. When paper obligations grow faster than productive capacity, assets grounded in physical reality regain importance. This environment explains the violence of January's price action. The collapse from 120 to the 60s was not a rejection of silver's value. It was a rejection of excess leverage. Speculative positioning had reached levels that could not withstand tightening financial conditions. When margin requirements were raised repeatedly, forced selling became inevitable. This process was mechanical, not conspiratorial. Leverage creates fragility. Remove leverage, and markets find equilibrium based on fundamentals. What followed that collapse is far more instructive than the collapse itself. Silver stabilized near $82 per ounce despite worsening physical indicators. Inventories continued to decline. Lease rates remained elevated. Delivery behavior did not reverse. This divergence between paper price stabilization and physical tightening is critical. It indicates that the sell-off transferred ownership from speculative holders to participants less sensitive to price volatility. Metal moved into stronger hands. Supply fundamentals reinforce this interpretation. Global mine output has remained relatively flat despite rising demand. Environmental constraints, declining ore grades, and capital discipline limit expansion. Even with higher prices, new projects require years to bring online. Recycling provides some elasticity, but it cannot close a structural deficit of hundreds of millions of ounces annually. Above-ground inventories fill the gap, and those inventories are finite. Demand growth, meanwhile, shows no sign of slowing. Solar deployment continues to accelerate globally. Each incremental increase consumes silver that cannot be substituted without sacrificing efficiency. Electric vehicles add further demand through batteries, motors, and control systems. Artificial intelligence introduces an emerging layer of consumption that is only beginning to be measured. Data centers supporting AI workloads require exceptional electrical and thermal performance. Silver's properties make it integral to these systems. These demand drivers are structural, not cyclical. As physical availability tightens, secondary effects intensify. Elevated lease rates incentivize hoarding rather than lending. Hoarding reduces float. Reduced float amplifies volatility. Volatility undermines confidence in paper instruments. Reduced confidence increases delivery demands. The feedback loop reinforces itself. This is not speculation. It is observable behavior consistent with historical precedents. Risk remains, and it must be acknowledged. Further margin increases could trigger additional forced selling in the short term. A strong dollar environment can suppress commodity prices temporarily. Coordinated intervention remains possible if authorities perceive systemic risk. A severe global recession could dampen industrial demand, though investment demand might offset it. These risks affect timing and path, not destination. Structural imbalance persists regardless. The distinction between price and value becomes essential here. Price can be managed, delayed, distorted. Value asserts itself through scarcity and necessity. Silver's value proposition rests on both. It is scarce relative to demand and necessary for modern technology. That combination limits the effectiveness of suppression over time. When systems attempt to override physical constraints indefinitely, they accumulate stress. Stress eventually releases. What we are witnessing is not a sudden crisis, but the slow erosion of an assumption. The assumption that paper claims can expand indefinitely without consequence. The assumption that delivery will remain rare. The assumption that price discovery can be separated from availability. February has challenged these assumptions. March threatens to invalidate them. Participant behavior tells the story more clearly than forecasts. Standing for delivery at unprecedented rates reflects rational response to perceived risk. Paying elevated lease rates reflects competition for limited resources. Drawing down inventories across regions reflects sustained imbalance. These are not emotional reactions. They are calculated decisions made by actors with capital at stake. This shift does not require unanimity to be disruptive. A minority acting decisively can stress the system sufficiently. If enough participants insist on physical settlement, the exchange must adapt. Adaptation takes the form of repricing, rationing, or restructuring. Each represents departure from the status quo. Each carries consequences beyond the silver market itself. As first notice day approaches, focus should remain on tangible metrics. Open interest trends reveal intent. Inventory movements reveal capacity. Lease rates reveal stress. Regional premiums reveal urgency. Together, these indicators form a composite signal that cannot be dismissed. They suggest that the silver market is no longer operating comfortably within historical parameters. It is approaching a boundary. Boundary conditions force resolution. Either price adjusts to attract supply or mechanisms are altered to manage scarcity. Both outcomes acknowledge constraint. Neither preserves illusion. The longer adjustment is delayed, the sharper it becomes. Markets that resist reconciliation accumulate pressure until release is unavoidable. Silver has endured suppression and distortion for decades. Those mechanisms relied on confidence and deferral. Both are eroding. When accountability arrives, it does not arrive gently. It appears as volatility, dislocation, and rapid repricing. January's events were not resolution. They were rehearsal. February is warning. March may be confrontation. Understanding this does not require certainty. It requires attentiveness. The numbers are public. The behavior is visible. The imbalance is measurable. 400 million ounces claimed against 100 million available. Structural deficits persisting year after year. Rising costs to access metal. Declining willingness to accept paper substitutes. These facts define the landscape regardless of opinion. Whether resolution emerges through price, policy, or process remains unknown. What is known is that the current configuration cannot persist unchanged. Systems that violate their own constraints eventually correct. Silver sits at the intersection of financial abstraction and physical reality. That is why it matters. That is why pressure here reflects tension across the broader system. As we move toward resolution, the most dangerous mistake is assuming that silence means stability. Systems under strain often appear calm just before adjustment because mechanisms designed to absorb pressure are still functioning. Once those mechanisms fail, change accelerates rapidly. The silver market is now in that late stage where buffers exist, but margins for error have narrowed dramatically. What determines the outcome is not belief, not narrative, and not prediction, but the interaction between obligation and capacity. When obligations exceed capacity for long enough, reconciliation becomes unavoidable. One of the reasons this moment is widely misunderstood is that most participants are conditioned to watch price first. Price feels authoritative. It moves visibly. It invites interpretation. But price is downstream. By the time it reflects stress, the underlying shift has already occurred. The leading indicators have been flashing for months. Delivery behavior changed. Lease rates rose. Inventories declined across jurisdictions. These developments did not require headlines to matter. They required attention. Those who understand market mechanics recognize that when multiple stress signals align, outcomes compress. The silver market structure magnifies this compression. Futures contracts are promises, not products. They function efficiently only when most participants do not intend to exercise them. That dynamic allowed leverage to expand far beyond physical backing. It allowed price discovery to drift away from availability. It allowed confidence to substitute for inventory. What February revealed is that this substitution is no longer universally accepted. When even a minority insists on fulfillment, the system must adapt. Adaptation rarely looks orderly. It tends to arrive through volatility, rule changes, and abrupt repricing. Exchanges respond by protecting themselves first. Clearing members respond by reducing exposure. Participants respond by securing assets. None of these actions are malicious. They are rational, but collectively, they accelerate transition. The system shifts from equilibrium to adjustment mode, and adjustment mode does not prioritize comfort. The concept of strong hands becomes crucial here. Metal that exits the exchange does not circulate easily. It moves into long-term custody, industrial consumption, or strategic reserves. It does not return quickly, if at all. Each ounce removed reduces available float. Reduced float increases sensitivity to incremental demand. This is why drawdowns matter more than inflows. A single large withdrawal can destabilize pricing far more than multiple small deposits can stabilize it. This phenomenon explains why efforts to suppress price through paper mechanisms become less effective over time. Suppression relies on abundance, or at least the perception of it. When abundance disappears, suppression requires increasing force. Increasing force attracts attention. Attention invites scrutiny. Scrutiny exposes imbalance. At that point, suppression becomes counterproductive. The system reveals its own fragility. The global dimension intensifies this effect. Silver is not confined to one market or jurisdiction. It flows toward demand. When Western markets export metal to satisfy Eastern consumption, they reduce domestic buffers. When logistics slow or availability tightens, regional premiums emerge. Those premiums signal urgency. Arbitrage attempts follow, but arbitrage cannot overcome physical constraint. When metal is unavailable, price becomes the balancing mechanism. The macroeconomic environment ensures that this balancing mechanism operates under stress. Currency systems globally face declining confidence. Debt obligations expand faster than productive output. Policy tools lose marginal effectiveness. In such an environment, tangible assets regain relevance not because of ideology, but because of necessity. Silver, with its dual role, becomes a pressure point. It reflects both monetary anxiety and industrial dependence. This duality is why silver's moves often appear disproportionate. It is not just reacting to investment flows. It is responding to competing demands from different parts of the economy. Investors seek protection. Industries seek inputs. Governments seek stability. These objectives conflict under scarcity. Price resolves conflict by rationing access. That rationing can be abrupt when scarcity is acute. The coming period will test assumptions on multiple levels. It will test the assumption that futures markets can defer delivery indefinitely. It will test the assumption that price can be managed independently of inventory. It will test the assumption that volatility equals risk rather than revealing it. Those tests do not require collapse to be meaningful. Even partial failure changes behavior permanently. It is important to separate outcome from process. The process may include sharp declines, sudden spikes, or extended consolidation. None of these invalidate the structural case. They reflect attempts to reconcile imbalance. The outcome, whatever form it takes, will reflect physical reality. That reality is constrained supply meeting expanding demand within a leveraged framework. History suggests that such situations resolve through repricing rather than replenishment. The timeline remains uncertain. Markets can endure stress longer than participants expect, but endurance should not be confused with resolution. Each delivery that removes metal tightens the system further. Each elevated lease rate confirms scarcity. Each declining inventory report reduces optionality. The system moves closer to a boundary with each incremental change. When that boundary is reached, response replaces debate. This is why preparation matters more than prediction. Understanding mechanics allows participants to interpret events without panic. It allows differentiation between noise and signal. It allows alignment between strategy and reality. Confusing leverage with opportunity or paper exposure with security creates vulnerability. Recognizing counterparty risk reduces it. The silver market does not require belief to function. It requires delivery. That simple fact anchors everything. Contracts exist to facilitate exchange, not to replace it. When exchange becomes constrained, contracts lose authority. Authority returns to possession. This transition has occurred repeatedly throughout financial history. It is never smooth, it is never universally acknowledged until after the fact. As February closes, the convergence of signals becomes harder to dismiss. Delivery behavior remains elevated. Lease rates remain stressed. Inventories remain under pressure. Demand drivers remain intact. Supply remains constrained. Price has reset leverage without resolving scarcity. The conditions that produced January's volatility persist, but with less excess and more intent. That combination is more powerful, not less. The question facing the market is no longer whether imbalance exists. It is how the system chooses to address it. Repricing acknowledges reality directly. Rule changes delay acknowledgement. Intervention obscures it temporarily. Each path carries consequences. None preserve the illusion of abundance indefinitely. Silver's role in this process is not symbolic. It is functional. It reveals where promises exceed resources. It exposes the cost of abstraction. It forces reconciliation between financial representation and physical constraint. That reconciliation is uncomfortable because it cannot be negotiated. It must be absorbed. Looking ahead, the most valuable perspective is clarity, not optimism, not fear. Clarity. Clarity recognizes that volatility is not an enemy. It is information. It reveals where stress accumulates and where it releases. Clarity understands that patience is not passivity. It is alignment with time horizons appropriate to structural change. When the adjustment completes, it will appear obvious, in hindsight. It always does. The warning signs will seem clear. The data will seem unambiguous. The question is not whether hindsight will arrive. It is who recognizes the present for what it is. February 2026 is not a conclusion. It is a threshold. 400 million ounces claimed, roughly 100 million available. Persistent deficits, rising costs to access metal, declining trust in substitution. These are not abstract concerns. They are concrete constraints. Constraints drive outcomes. When systems collide with constraint, narratives dissolve. The silver market is approaching that collision point. Whether it manifests through price acceleration, structural change, or policy response remains to be seen. What does not remain in doubt is that the existing configuration cannot persist indefinitely. The math does not allow it. The behavior confirms it. The pressure is real. As this phase unfolds, remember that markets reward preparation, not prediction. Understanding mechanics matters more than timing. Recognizing imbalance matters more than chasing momentum. Silver is not moving because of belief. It is moving because reality is asserting itself. And reality, unlike sentiment, cannot be managed away.